Welcome to Value Vest Daily, where we analyze the best value and momentum investment opportunities. Today, we're going deep. We're looking at the real engine powering the entire AI revolution. And trust me, understanding this one thing could change how you see the future of tech entirely. So let's just jump right in. What if I told you the key to figuring out the future of NVIDIA, Tesla, and Google has almost nothing to do with their software, and everything to do with a quiet war being fought over hardware deep inside their data centers? It all comes down to a fundamental misunderstanding of two types of AI chips. If you can get your head around this, you'll see the next decade with so much more clarity. But if you get it wrong, well, you could be betting on the completely wrong horse. So just take a look at this. This chart is basically the entire world of AI computing. That tiny little 10% sliver, that's AI training. It's the part that gets all the headlines, all the hype. But that giant whopping 90%, that's inference. That's the AI actually doing stuff out in the real world. And here's the core idea for today. While everyone, and I mean everyone, is obsessed with that 10%, the real, lasting, multi-trillion-dollar value is being built in the 90%. Okay, so here's our roadmap. First, we're going to nail down exactly what training and inference are. Then we'll look at how the big dogs, the tech titans, are playing this. We'll do a head-to-head showdown between NVIDIA and Google's chips, and then we'll wrap it all up into a clear investment outlook and some key takeaways you can actually use. All right, let's get into it. Before we can even begin to talk about stocks or strategy, we have to get this part right. These are two completely different worlds. So, AI training. Think of this like sending an AI model to college to get a PhD in, well, everything. It is a brutal, power-hungry, and insanely expensive process. You are force-feeding it gigantic datasets, like the entire internet, and it just sits there for weeks, sometimes months, crunching numbers and learning patterns. This is the one-time heavy-duty process of creating the AI model in the first place. Now, if training is the PhD program, inference is the AI's entire 40-year professional career, happening millions of times every second. This is where that already trained model gets put to work. Every single time you ask ChatGPT a question, every time Tesla self-corrects its steering, every time Google gives you an instant search result, that's inference. And it has to be lightning fast, super cheap, and endlessly repeatable. You know, here's maybe the best analogy for this whole thing. Training is like a giant, roaring industrial blast furnace. It's massive, it consumes a terrifying amount of energy, and you use it to forge one single thing, the finished AI model. But inference? That's the finished knife that comes out of the furnace. It's perfectly balanced, super efficient, and designed for one specific job, a job that's going to do millions and millions of times. One blast furnace, billions of knives. And hey, don't just take it from me. Look at what venture capitalist Chamath Palihapitiya said. He put it so bluntly. Inference is going to be 100 times bigger than training. Now, he's not just talking about dollars here. He's talking about the sheer volume. Think about it. A model gets trained once, maybe updated a few times, but it performs inference. It does its job trillions of times. It's like you build one car factory, but you drive the cars that come out of it every single day. And of course, the money follows the volume. This is where it gets really interesting for us as investors. By 2030, the market for those training chips, the blast furnaces, is expected to be about $60 billion, a huge number. But the market for the inference chips, the knives, it's projected to be $250 billion. It's not even close. The real long-term money is in making those trillions of real-world interactions happen cheaply and efficiently. Okay, so now that we've got that core concept down, we can get to the really fun part. Analyzing how the biggest names in tech are placing their bets. Who's all in on the blast furnace and who's secretly building the world's biggest knife factory. Let's start with the undisputed champ, NVIDIA. They are the kings of the blast furnace. Their H100 and new Blackwell GPUs absolutely dominate the training market. But, and this is a huge but for investors, about 80% of their data center money is already coming from inference. So they're basically selling these incredibly expensive, do-everything Swiss Army knives to a market that just wants a cheap, perfect steak knife. Their whole strategy is to protect that position with their amazing CUDA software and just hope that one-size-fits-all continues to work. It's a risky bet. Then you have the quiet challenger in the corner, Google. They have a secret weapon called a TPU, or Tensor Processing Unit. It's a custom chip they designed in-house. And for inference, these things deliver 2 to 4 times better performance for every watt of electricity you use. Basically, way more bang for your buck.
And Google's strategy here is frankly brilliant. It's a 1-2 punch. Use this chip to run their own massive services cheaper, and then rent out that same advantage to everyone else through Google Cloud.
And this isn't just some theory. You can actually watch it happen. Step 1. They're shipping about 2.5 million of these things this year. Step 2. They're using them to land these monster deals with companies like Anthropic and Meta. Step 3. This all adds up to an estimated $45 to $60 billion in new cloud revenue by 2030. And step 4, the bottom line for us, that alone could add over $60 a share to Google's stock price. And then there's Tesla. They're playing a completely different game. They're not just in the race, they're building their own racetrack. For years, they've had this painful problem. They had to train on expensive NVIDIA chips and then do all this complicated work to get the model to run on their own custom chips in the cars. Their solution? The AI5 and AI6 chips, which are designed to do both. Their strategy is to build a moat around their business that is literally impossible to cross, with custom silicon powering everything from their cars to their robots. And they are moving at a truly insane speed. I mean, look at this roadmap. They're getting the first samples of their next-gen chip next year, full production in 2027, going right into cars and robots. And just a year after that, the next version with double the performance. They're aiming for a brand new, more powerful chip every single year. That's the kind of speed you see when a company believes hardware independence is the absolute key to their future. So yeah, cool chips, but what does it mean for the stock? The numbers here are just staggering. By 2027, this custom chip strategy could be saving them $2 to $3 billion a year. By 2030, that number could jump to $10 to $15 billion a year. And here's the part that should get every investor's attention. Some analysts believe this strategy alone could add up to $78 per share to the stock price, just from the cost savings. All right, we've seen the big strategies. Now let's put the hardware itself under the microscope. This is the main event, the heavyweight fight, NVIDIA's GPU versus Google's TPU. You know, you'd think their specs would be wildly different, but here's the surprising part. Look at this. On paper, NVIDIA's newest GPU and Google's newest TPU are shockingly similar. Compute power, basically the same. Memory, identical. Power draw, right in the same ballpark. So the battle isn't really on the spec sheet, it's a battle of philosophy. NVIDIA is selling versatility, one chip that can do anything. Google is selling pure, ruthless efficiency, the absolute most performance for every single dollar you spend on inference. Okay, enough with the theory, let's follow the money, because that never lies. Take Midjourney, the AI image company. They use NVIDIA's powerful GPUs for training. But for inference, when millions of users are actually making images, they moved 65% of that to Google's TPUs and cut their costs by 65%. Anthropic, the makers of Claude AI, did something similar and saw their costs drop 40%. Even Meta is reportedly lining up a multi-billion-dollar deal because they see 3 to 4 times better performance per dollar. The biggest players in AI are all voting with their wallets for inference efficiency. All right, so we've covered the tech, the companies, the market, the whole shebang. What in the world does this mean for your portfolio? Let's try and distill this all down into an actual investor's playbook. So here's kind of a summary of the long-term outlook, based on everything we've discussed. For Tesla, some bullish cases see them going to $2,600 a share or more by 2029. The whole idea is they become the ultimate inference company, using their own chips to make robotaxis and robots wildly profitable. For Google, a base case could put them over $400, based on the thesis that it's a super undervalued AI play that's using its TPUs to quietly take over the massive inference market. And NVIDIA? Well, that's the big question, isn't it? They are still the king of training, but investors have to watch their inference market share like a hawk. If they can't compete on cost, those legendary margins could be in real trouble. All right, so if you take away nothing else from this whole deep dive, just remember these key points. 1, inference is where the long-term money is. It's just a much, much bigger market. 2, custom chips, like what Google and Tesla are doing, are starting to chip away at NVIDIA's dominance because they are just more cost-effective. 3, for Tesla, a huge chunk of their future growth story is tied directly to the cost savings from their own chips. 4, Google Cloud is getting a massive boost from its TPU advantage. And 5, NVIDIA faces a very real risk here if they can't find a way to compete on the economics of inference. And of course, the obligatory disclaimer. Just a reminder that all of this is for informational and educational purposes. It is absolutely not financial advice. You should always consult with a qualified professional before making any investment decisions. If you got some value out of this deep dive today, it would mean the world to us if you'd hit that subscribe button, give this a like, and maybe even share it. We're trying to build a community here where we can all learn before we put our money to work. And hey, please drop a comment below. We read all of them. Let us know if there's a specific high-risk, high-reward opportunity you want us to tackle next. Thanks for watching.